The views expressed in this podcast are not to be taken as either trading nor financial advice. Neither the announcer nor the Sirius Report make any claims to be certified financial advisors, and all reporting is dedicated solely towards being both informative and educational. Greetings, everyone. Welcome to the Sirius Report Market Wrap-Up for Tuesday, October 29th, 2024. I apologize to everyone that this is a little bit later today and missed Monday. Real life stuff gets in the way on occasion, so hopefully you can bear with me on that. What we're going to take a look at today is a lot of economic data that has come out. All-time highs now in, the gold, silver, not quite silver, and a big move in cryptocurrencies, especially Bitcoin. As I mentioned, a lot of economic data. We're going to see which country an economic think tank has decided is probably the biggest economic has the forecast for the best economy going forward. And we got a few other things we'll take a look at. So with that in mind, let's go ahead and jump right in and see how the market's fared. Well, interestingly, the Dow started up when we had some information regarding CPI, potential CPI for later this week. But instead, it was a sell-off for the rest of the day, and the Dow was down 154 points, closing out at 42,233. Meanwhile, both the S&P 500 and the NASDAQ were in the green. NASDAQ was up 145 points to close out at 18,712, while the S&P 500 was up just short of 10 points, closing out at 5832. Meanwhile, in the bond market, astonishingly, after a very bad session selling 2-year bonds yesterday, the 7-year auction was quite good. At least, accordingly, you never know if when you have foreign buyers, if it's simply the Fed using their primary dealers overseas, or if it's actual foreign buyers as a whole. But it was strong enough to take down most of the yield curve across the board. As we saw yesterday, the 10-year had gotten above 4.3%, but today it closed out at 4.256. The 30-year is at 4.5, 20-year 4.6. So the back end of the yield curve is definitely higher than the 10-year, and the 2-year is at 4.1%. In the dollar markets, dollar had a little bit of volatility between the open at 9:30 Eastern time and about 1 o'clock Eastern time, but that volatility ended up with being a relatively flat day. The dollar in the DXY against a basket of currencies, Western currencies, was down 3 cents to 104.28. While gold and silver started out sluggish, they ended the day with a bang. Gold was up $32.80 to close at a new all-time high of $27.75, and silver was up 76 cents, closing out at $34.51. Now, silver's had a little bit of a fight to get back to its level. I believe it was on Thursday or Wednesday or Thursday last week. We had silver get intraday above $35 on the December 24 contracts. Immediately in the next day and a half, it was beat down to just above $33 to $33.05, and it's worked its way back to $34.51 as of the close today. In the crypto markets, really strong moves over the last few days. Bitcoin had got as high as 73,570 over the last 24 hours, ended the session up 3.35% to 72,266. Meanwhile, Ethereum was up 2.10%, closing out at 26.19. In the oil markets, after the beatdown from Friday of more than $4 in the WTI, it was relatively flat today. WTI ended up down 17 cents, closing out at 67.21, while Brent crude was as flat can be, no upward, no downward slide, and it remained at the close of yesterday 71.42. Well, there is a new revision out in regards to job openings. Let's see here. According to the BLS, which of course is government institution, in August, the number of job openings unexpectedly soared from an upward revision of 7.7 million to 8.04 million, which was not only a 3 sigma beat to expectations, also above the highest Wall Street forecast. Fast forward to today, as the media seems to be leaving the Biden administration in droves, the BLS reported that in September, the jobs openings plunged from that revised 8 million to just 7.4 million. This is the lowest since early 2021 when we had the lockdowns and the layoffs. This was a 6 sigma miss to expectations, and as you notice, it dropped even below the 7.6 million job openings that were revised upward, so we're at 7.4. In the conference board, consumer confidence, we had a little surge in October. Analysts expected a small rebound in the conference board's consumer confidence for October. Instead of a small rebound, confidence exploded higher, with the headline rising from 99.2 to 108.8. A measure of expectations for the next 6 months rose 6.3 points in October to 89.1, while the gauge of the present conditions was up more than 14 points to 138. What is the biggest driver? The expectation that Donald Trump is going to win the election. Pure and simple, nothing else. Okay, home prices. U.S. home prices remain near record highs, but guess what? Yesterday, mortgage rates reached 7% once again. With mortgage rates reaccelerating, the housing market faces another worsening affordability crisis, all since the Fed came out and cut rates. Markets doing exactly the opposite of what the Fed expected. And just to add some more pain, SP CoreLogic's Case-Shiller data for August shows home prices in the top 20 cities in the U.S. rising 0.35% month over month, much hotter than the expectations. However, despite the beat, home prices rose just 5.2% year over year, and the fifth straight monthly decline slowdown in year over year growth. But with inflation starting to return, and we know this by looking at the yields on the treasuries, that is going to get even worse, because as interest rates and mortgage rates start to climb, the question is, last time we were at 7%, housing prices really didn't fall. They rose. So is it inflation on both sides of the fence? Your guess is as good as mine, but I would put the money on that being the truth. Taking a look, we get to, even though this came out yesterday, we'll look at the data for week ahead. As I mentioned, Case-Shiller HPI and consumer confidence, along with JOLTS job openings, was today. Tomorrow we've got GDP, which expectation is 3%, 3%, 3% across the board. And if you really believe we grew at 3%, well, I got some hurricane-torn land in Florida to sell you. We also have tomorrow pending home sales. On Thursday, we have initial jobless claims. Then we have, let's see here, going into Friday, non-farm payrolls, which of course is a big one, and ISM manufacturing. Well, here's a question to ask. Is the dollar collapsing? Of course, the answer is no, but is there a path for the dollar to collapse? Doug Casey over at the International Man laid out 7 indicators that really people cannot ignore, and we have to take a look and see if there's any feasibilities behind them. Now, according to a chart that Doug Casey and his crew put together, the debt spiral and the currency debasement, starting with government spending, leading to budget deficits, debt issuance, interest expense, interest cost control, the money supply expands, prices rise, which then causes the government to go back and start doing it all over again. Let's see, there's U.S. federal budget deficit projections and actuality. It's important to note that projections have the ridiculous assumption that there will be no wars, recessions, and other events that cause extra federal spending. Even with this rosy and unrealistic forecast, U.S. government is projected to have a cumulative deficit of over $22 trillion over the next 10 years, which has to be financed by issuing more debt. Then we move to the next phase, the federal debt, which stands at $35 trillion, representing more than 123% of GDP. And it's important to remember that GDP itself is a flawed statistic, since it relies upon 70 to 75% being consumer spending, as long as the consumer is okay and can buy things from retail. But we know that not only are we starting to see a lot of job layoffs, but we are also starting to see a lot of bankruptcies in the restaurant business and the hospitality. Many of the things that the U.S. economy has had to go to since it offshored its manufacturing and industry back in the 90s. Let's see, in the U.S., government spending accounts for at least 37% of GDP. So while consumer spending was 70 to 75%, probably going into 2022, that's now gone down, and U.S. government spending has taken over a lot of that. Indicator 3, the federal interest expense. We mentioned this a few days ago. For the first time ever, the interest on the federal debt is higher than that of the defense budget and has exceeded $1 trillion for the first time. Then, of course, we have the federal funds rate. The interesting thing about the federal funds rate is, if you notice, the 10-year and the 30-year are moving upwards towards 4.5%. Well, when Powell cut the Fed funds rate by 50 basis points, he went from 5.25, it was 5.25 to 5.5%. Now it's 4.75 to 5%. That means that with the 30-year at 4.5% and the 10-year sitting at 4.25%, it's getting awfully close that the interest, the yields on the treasuries are going to be higher than the Fed's fund rate. And that's going to make borrowing from the Fed extraordinarily costly. Then, of course, we have the money supply. And as the U.S. government continues to borrow, continues to deficit spend, continues to increase the debt, that means there's going to be more currency out there. It's going to create higher and higher inflation. And the Fed is not in any position to raise the Fed funds rate or the interest rate to any real number that could try to stop this rising inflation. And of course, the fiscal policies of the federal government are doing nothing to try to deal with inflation as such. Then we've got indicator number 6, the consumer price index, which of course is the most politically manipulated statistic of all. It doesn't have things like the interest one pays on credit cards, the cost of home insurance, the rise in that, which has skyrocketed, or in car insurance. So many things are not in the consumer price index that the Fed relies upon and the federal government, that it really can't measure the true rate of inflation. Not like it did back in the late 70s and early 80s under the Volcker years. Finally, the gold price. The gold price, of course, is screaming right now how bad the dollar is losing value, purchasing power and value, and where wealth protection is being stored in gold. This is why central banks are buying it, because they know the jig is up. We know that the multipolar world, the BRICS countries, China, India, and such, they're all buying gold, and they're recognizing that it's going to be an alternative of wealth protection as the dollar continues to decline. Well, finally, I mentioned there was a country that was leading the way the fastest economic growth in the last decade, and of all places, it's Russia. Richard Conley, a junior research fellow at the Royal Institute of Shared Services in London and an expert on the Russian economy, told mainstream media that the number of small and medium-sized enterprises, i.e. businesses, registered in Russia has reached an unprecedented level. In the wake of many Western companies leaving the country or suspending their operations due to the sanctions put on Russia, these companies were quickly replaced by Russian versions. So instead of Starbucks, they have Stars Coffee. Instead of Zara, they have Mog. Instead of Coca-Cola, they have Dobry Cola. So everything that the West provided to Russia before the sanctions, they left the factories, they left the intellectual property, and it was quickly bought up and created as a small business by the Russian people themselves. And this is one of the big reasons why they are not dealing with high inflation due to being cut off by SWIFT, and they are seeing economic growth because, you know what? They're actually producing something. Anyway, I want to thank everybody as always for stopping by on this Tuesday to get your market wrap-up for October 29th, 2024. Paul and I have 3 more podcasts we recorded today. 2, interestingly, are going to be on elections, since we're 1 week away from the U.S. election and Europe is experiencing its share of elections. So we're going to get some commentary on that. And then we're going to take a look at some other financial news later this week. So don't forget to subscribe, like, share, comment. Send this out to anybody you think might be important. And until the next time we get together, everyone, have a great Tuesday.